The utilities sector, as explained by the Global Industry Classification Standard, or GICS, consists of electric, gas, and water utility companies who produce or distribute power, as well as those who generate electricity through renewable means. Companies within the utilities sector often have large market caps and are generally long-term value holds, as they often generate dividend income. On top of that helpful dividend, public dependence and being incorporated within the nation's infrastructure make utility companies strong investments in times of economic downturns. Keep watching to see if the utilities sector is currently the best place to keep your cash, and stick around till the end of the video to see which utilities sub-industry is the best investment over the next decade. Splitting 2022 in half, we can see the energy sector was the winner from January to May 2022, returning 50.79% more than the S&P 500. However, from May to September 16, 2022, we see the utilities sector take the lead over all others at 8.6% relatively. We can assume as the market continues to perform worse, strong dividends and reduced volatility elevate the appeal of utility investments. Although utilities companies make for good recessionary investments, you can check out my video on the sector rotation theory for more info regarding that. They are sensitive to certain macroeconomic drivers. Because utility companies rely on massive amounts of expensive infrastructure, they often carry large amounts of debt on their balance sheets, making the threat level of increasing interest rates high. Increasing inflation also challenges utility companies as the price of costs increase faster than their revenue. This is a medium-high threat level because utility companies belong to the public service infrastructure, meaning their prices are set by regulators, and if operation costs increase, they are generally granted the ability to increase prices, passing the cost of inflation onto their consumers and protecting profit margins. The Treasury spread also gives us information on how utility companies will perform, because many long-term investors who are chasing high dividend yields will either invest in long-term bonds or utility companies, but generally not take large positions in both. As the yield on 10-year Treasury bonds increases, investors who would otherwise favor dividend income from steady utility companies as bond substitutes will look upon utilities less favorably. This means the dividend yield of utilities theoretically moves inverse to the 10-year Treasury yield, but the actual 2-10 Treasury spread offers little threat to the utilities sector, as an increasing short-term Treasury yield has less significance. The last macroeconomic driver we look at, gross domestic product or GDP, has a medium to low threat level because utilities are capital intensive and they require consistent inflows of funds in order to finance infrastructure upgrades, purchase new assets, and keep up with operational costs. Despite the overall real GDP currently decreasing overall, utilities and real estate contributed least to these losses compared to all other sectors. Now that we know what the utilities sector as a whole is sensitive to, we'll be determining which sub-industry performs best. As reported by FinViz, year to date, the regulated gas sub-industry has performed the best relatively, followed by renewables and independent power producers, then diversified utility companies. The gas utility industry is affected by the price of coal and natural gas. When the price of natural gas rises, utility companies are often allowed to pass this on to consumers as long as regulators allow it. Furthermore, targeting utility companies such as Eversource Energy, stock ticker ES, which owns subsidiaries that produce natural gas and other fossil fuels, can lead to increased profits as natural gas prices increase dramatically, which should continue to happen through the winter months. The renewable energy industry is currently being driven by strong political backing of a clean future, as Biden's climate and environmental justice proposal will make a federal investment of $1.7 trillion over the next 10 years, leveraging additional private sector and state and local investments to total a sum of more than $5 trillion. Although replacing the nationwide infrastructure to transition to renewable production sources would be incredibly expensive, government subsidies are an incredibly large factor which has allowed companies to face these changes without feeling burdened, as exemplified by the U.S. Energy Information Administration's 2050 energy consumption estimate. Here are some renewable utility companies graphed by their year-to-date returns and PE ratios to ensure they aren't heavily overvalued. Constellation Energy Corp, ticker CEG, has performed incredibly year-to-date, about doubling their share price. Their PE ratio of 44.11 is mildly concerning despite the renewable industry being somewhat speculative still, but it is consistent with such drastic price increases. The other renewable industry companies which have beat out the S&P 500 year-to-date are AMPS, BEPC, CWEN Series A, NEP, and AQN in that order. Here are the multi-utility sub-industry leaders, including some of the companies we just previously looked at. Sorting these companies by scooter ranking allows allows us to see which securities have the strongest current technical momentum relative to the group, and it did change our contenders significantly. Notice the renewable companies we just looked at have high scooter rankings despite having less than stellar returns. NAP, with a scooter ranking of 85.3, we see that despite returning just below 0% year to date, they are currently in a strong upward trend compared to a company like Algonquin Power and Utilities Corp, AQNU, who have a much lower scooter ranking of just 49.2. Looking at the relative returns of individual utility companies belonging to different industries and compared to the Spider Select Sector Utility Fund, XLU, can help narrow down potential investments. The only two companies charted with returns lower than XLU as a whole include Dominion Energy, ticker D, a conventional electric company, and York Water Co., YORW. This is consistent with what we've discussed thus far, as the rising interest rate climate is hampering revenue of companies with large amounts of debt, as both of the electric and water utility companies are faced with an expensive long-term future outlook due to their infrastructure maintenance costs and increasing regulatory pressure to replace existing infrastructure and operations with environmentally safe renewable options. This is especially threatening for the water utility industry, as water systems built in the past generations are reaching the end of their lifeline. We've looked at some individual utility companies which have performed very well this year thus far, but which utility industry has the highest ceiling to perform in the future? If you haven't figured it out already, we're staying away from the water utilities due to their infrastructure issues. Gas utilities present an okay option for the time being, as the price of natural gas has climbed steeply, but this will not be the case forever, making them moderately strong. And electric companies are receiving a medium low on the strength meter despite their troublesome infrastructure problem and rising rates. Thankfully not as bad as the water industry. They're slightly stronger than water utilities because some of these companies are tapping into the renewable market, as production costs have decreased dramatically since 2010. Multi-utility companies have performed well this year and will most likely continue to do so, as they are well diversified in multiple industries. We've also seen many of these companies turn towards renewable options, which I'm sure you figured it out by now has the strongest long-term outlook for the utilities sector. In addition to the trillions of federal and private dollars declared to drive the clean energy initiative, Deloitte outlines 5 things to pay attention to regarding renewables. Link will be in description. We've seen a growing interest in clean energy recently, allowing for renewables such as solar and wind to be more easily integrated into the electric grid. Furthermore, this newfound excitement and administrative backing to combat climate change has led to the research of new, cheaper renewable alternatives such as green hydrogen. You should also pay attention to new business models in the solar industry, which is driven by an 85% decrease in operating costs over the past decade. This industry is very cost competitive, and companies rely on exploring new ideas to set themselves apart from their competitors, such as floating solar modules and expanding community solar projects, which allow for consumers who cannot afford to purchase their own solar panels to benefit from shared solar power. As renewables gain more steam and new alternatives such as offshore wind farms are explored, there will be an increased demand for infrastructure development to strengthen access, as these new technologies will need to be incorporated within the existing infrastructure. This may sound awful expensive, but policy and regulatory support, investments, and innovation will likely help hasten progress. Keep an eye on offshore wind in the coming months, as Deloitte also states about 90% of proposed renewable power capacity is stuck in transmission interconnection queues, especially for offshore wind, which must be connected to coastal infrastructure. Through 2021, the supply chain for the renewable energy industry was extremely poor, resulting in negative year-over-year returns for the first time since 2015. As the supply of components, raw materials, and labor continue to increase, revenue should increase as well, but this will take time, and utility companies will continue paying premiums on operating costs for the time being. Lastly, the renewable energy industry is currently in a unique position to entice their consumers, as the first generation of renewable products are reaching the end of their life. Utility companies can sustain growth by offering EOL, or end-of-life product replacements, recapturing the reinvigorated revenue stream. These new systems will also be much more efficient, as almost a decade has passed, allowing for an increase in profit margins as well. We've talked a lot about utilities today, but if there's one thing to take away, it's that utility companies may be sensitive to increasing interest rates, but they do offer less volatility than the broader equity markets, and you really can find some strong, consistent dividend payers who will help protect your portfolio during times of market downturns. Subscribe to the channel to get notified about the remaining sector deep dive videos, and please like the video to show your support. As always, I'm Patrick Zimmerman. Thank you for your time, and have a nice day.